Good evening, everybody. No, not going to be late tonight. Appreciate everybody being here. Before we go any further, please take a moment and read this disclaimer. Please pause the video, take a read. I am not a financial advisor. I am not your financial advisor. I just do a lot of research and make these videos to hang out with everybody for educational and entertainment purposes only. So, I got a lot of messages about JEPI, probably more messages about JEPI than Verizon at this point. So I figured, you know what? Amit and I are going on later at 9:30. We do a video specifically on just JEPI and Verizon. So covered call ETFs have gotten very popular probably since the pandemic. It really started exploding, and more brokerage houses came out with covered call overlay products. Global X was the big pioneer with QYLD and XYLD. Both of those came out in 2013. What those ETFs do is they cap pretty much all the upside by writing covered calls at the money. And you trade the upside for immediate reoccurring income. The problem with those funds, as we have now seen through the data, it's harder when the markets take a large drawdown and then whipsaw back in 2 to 3 months for it to get back to where it was because of how much of the upside is capped. So now you have JP Morgan Asset Management, you have Goldman Sachs, Neos Investments, and some other houses such as Roundhill, all creating covered call ETFs, variations of them. JEPI still is the king by assets under management, which is AUM. So I'm going to bring up the screen now. And it's funny because it looks like there's other contributors on Seeking Alpha that are agreeing with me that it's no longer the advantageous play that it once was. It's pretty interesting. And it's even more interesting that high yield investors said why GPIX is the best S&P 500 income ETF. I use GPIX as an example in my article. You have Jack Bowman saying now it's time to pivot. I'm not exactly pivoting, but I'm certainly not adding to it. By assets under management, it is still the largest. There's no other income-focused covered call strategy ETF, to my knowledge. There may be, but to my knowledge, that has more than 41 billion in AUM. I don't know of another one. Now, this fund has done very well from an income perspective. You get a strong monthly distribution. Now, it fluctuates for many different reasons. The way that JEPI is comprised, it allocates 80% of its resources toward equities within the S&P 500, and the management team picks equities that they feel will be less volatile. Then they do 20% into equity-linked notes, which is a different type of investment vehicle where they run their covered call strategy on that side. The idea is that they leave the 80% uncapped. The big thing with JEPI is they're not going on a weighted aspect with the S&P. So Alphabet's their largest holding, Amazon is their fourth largest, and then Apple and Microsoft, but it's very equal weighted, but not toward the S&P. Equal weighted, at least for the top companies, toward themselves. And you're missing NVIDIA here. You're missing Tesla. You're missing Meta. Now, I'd be willing to bet they're somewhere down lower than the top 10. Fact that they have NextEra Energy up here and Ross Stores and AbbVie and Johnson & Johnson, this is not a growth focused by any means. And leaving the 80% uncapped is likely to not perform as well as some of the other funds. Now, The reason why I use GPIX and not GPIQ is because GPIQ is the Goldman Sachs ETF for the NASDAQ. I would use that in a comparison with JEPQ, which is JP Morgan Asset Management's ETF focused on the NASDAQ 100. When I look at the actual data, so give me one sec. All right. So since its inception, JEPI has generated $26.51 of distributed income from 65 distributions. It's generated a yield on cost of 53%, and its total return was an additional 15.62% since inception. Interesting numbers. And when we look at this compared to XYLD, because XYLD is the only one that has the long-term structure, it looks good. Problem is, when I look at SPY and QQQ as the band for where we're going to gauge these investments off of, doesn't look good, because a 68.84% total return is not great compared to 143% for the S&P. Now, I completely understand the idea of, well, it's here to generate yield. And yes, but it's not generating enough yield to pick up the slack and consider allocating capital toward SPY and doing a different variation to generate income from that. So on a shorter basis, I looked at JEPI versus XYLD, SPYI, and GPIX since the beginning of 2024. And you have almost 2 years worth of data on this. JEPI has the second worst amount of appreciation out of those 4 covered call ETFs. Now, SPYI takes a call spread approach where they write covered calls or write options against their positions. They retain a portion of that premium, and they buy out of the money call options to create a call spread, which allows them to pay out a large distribution from the retained premium. But they also benefit if the market appreciates, because those out of the money call options get triggered for the appreciation. That's why SPYI has been able to do 9.68% of appreciation instead of 5.06% for JEPI. GPIX is a dynamic approach where they do not have to write or overwrite at 100%. They can take a pragmatic approach where if they feel a position is going to run past where they would write the call option at, they'll leave it uncovered to pick up the additional appreciation. Now, its distribution yield is certainly less than SPYI, but its appreciation is more than double over this period of 23 months. So when we look at the total return, GPIX and SPYI through different vehicles are somewhat competitive with SPY. Not necessarily, but it's much more competitive than JEPI, where JEPI is at 20.72% and SPYI and GPIX are over 30%. So from an income perspective, they both produce more. From an appreciation perspective, they both produce more. I also looked at the numbers on a year-to-date basis. And on a year-to-date basis, SPYI and GPIX are slightly trailing SPY this year. 14.69% and 14.83% total return. JEPI, on the other hand, 7.48%. Now, I get it. I love income. I love income producing assets as a side of my portfolio, and I completely understand why people are willing to sacrifice appreciation for the reoccurring income. I get it. The thing that I am thinking about now is, can JEPI turn the corner? And I don't think that they will anytime soon. Not that they can't, but I think they need to make some different decisions in how they build out the portfolio. And the numbers are the numbers, whether we look at it since its inception, over the past 23 months, or over the past 11 months. The data is still the same, at least for the past 23 and the past 11 months, where it is significantly trailing SPYI and GPIX. So this is why I've been saying it is no longer the king of covered call ETFs. And I think GPIX and SPYI have built better mousetraps than JEPI. And unfortunately, what was once held in a very high regard, I think is starting to really lose steam. And I think as time goes on and more people realize, especially with Goldman Sachs's brand, you have to think Goldman Sachs is just as powerful as a JP Morgan from a branding expectation. So I got to think that we're going to see many more investors moving toward SPYI and GPIX. So I'm bullish both of those. I'm neutral on JEPI. I have not been adding to JEPI. I have been adding to SPYI because for me, the distribution yield is very interesting and I'm just plowing it right back in. I'm plowing it right back into all of them. But at 1% per month, the powers of compounding can do really well, especially when you continuously are adding shares. So I'm really happy with the investment and it works for me as part of a very, what would be the right word considering how many positions I have. I don't even know if you can call it diversified anymore because it's well past diversified, but we'll use diversified. It's certainly not consolidated. So I'm more bullish on SPYI and GPIX for income these days. And that's where I am at on JEPI. So I will open up the chat and look at the comments. And if anybody has any questions on JEPI, please let me know. And then I want to discuss some thoughts on Verizon that I was thinking about the other last night and this morning after I signed off. So good question, Sergio. So Sergio had asked, where's QQQI or other NEOS funds? They're crushing it. Once again, it all depends on what I'm comparing. So these are the ETFs that you compare against SPY. If we were going to compare something that was replicating the NASDAQ, such as JEPQ instead of JEPI, you would see QYLD instead of XYLD. You would see QQQI instead of SPYI, and you would see GPIQ instead of GPIX, because those would be the ones that replicate more closely a NASDAQ 100 portfolio rather than S&P 500 portfolio. Side topic, do you like SCHD? I am in SCHD. I don't think I'm going to get out of it. I have a very hard time with the whole dividend growth versus high yield, but I've run the numbers. If you hold SCHD long enough, and if it continues increasing the dividend at this rate in, I don't know, 12 years or so, it'll catch up. I mean, it's a big dividend growth, so it's a compounder. You got to hold it. Let's see. I'm not into VIG. VIG's got, I believe, a lot less yield than SCHD. QQQI falls into the group with the NASDAQ ones, not on the S&P ones. I don't hate SCHD. It was better a couple of years ago. I mean, a couple of years ago, it was rivaling SPY, and then they changed the portfolio, and it's less tech heavy. So the appreciation is not what it once was, but still a great ETF. So that's my thoughts on JEPI. Let's see. So I want to just touch on Verizon real quick. So Verizon, as I went through all the numbers last night, I was thinking about that more and more, and I actually bought some more today. Full disclosure. So I think Verizon's a very misunderstood company, and I do think it's a modern day utility at this point. Verizon's not going to grow 20% year over year. I don't expect it to grow 20% year over year. I don't think it's realistic for anybody to have that idea on the top or the bottom line. But at the same time, can Verizon be a tool for forward growth? Yeah, sure. But here's where it gets very interesting. Let's bring up the dividends. You're getting paid around 7% right now on Verizon. So you got 20 years of dividend growth, a 1.95% dividend growth rate over the past 5 years, a sub 60% payout ratio, and a yield at 6.77%. And when we look at the history, that's a really strong dividend chart. It's a really, really strong dividend chart. And I think the big idea right now is, would people trust Verizon to continue paying the dividend? So we're in an environment where, as far as we saw it today, it looks like Hassett's going to get the job of Fed chair. And if that happens, it's going to be very bullish for lower rates. In a lower rate environment, it is less likely people are going to be allocating toward the 12-month or the 10-year. I mean, if we look at where the 12-month is, you got the 12-month at 3.6%, and it's only going to go lower. You got the 10-year at 4.09%. That's likely to go lower also. So for those of you that are unfamiliar with bonds, it's a coupon that pays you annually. So you'll be locking in a 3.6% yield for 12 months. Or over a 10-year period, you're locking in a 4.09% yield every year. That's not a big yield by any means. And Verizon, while it has gone down, okay, this has been, and I said this to Amit this morning. So forgive me for those of you that listen to Amit's stream this morning. Verizon's down 9% over the past decade. This has been a decade of lost growth. You look at SPY, or we look at the S&P, over the past decade, 238%. Obviously, there is no comparison in these investments. I'm not buying Verizon for the company it was 10 years ago. I'm buying Verizon for the company it is today. It's just like what Billy Beam said to David Justice. He's not paying David Justice for the baseball player that he was. He's paying him for the player he is. It looks like to me Verizon has bottomed. I mean, we look at a 5-year chart. It looks like it bottomed heading into 2024 in the 30 range. Looks like it's been hovering. Now, look, I don't do technical analysis a lot, but I can spot patterns on a chart, and it certainly looks like we already hit the 5-year low, and it looks like there's a big level of resistance around 38 because I don't think it cracked that. It doesn't look like it cracked 38 when it did that dip, and it looks like it just wants to stay above 40. And I would say at $40.61, for me, I have a lot of conviction it's going to stay over 40. And if it's going to stay over 40 for a longer period of time, paying what it's paying, to me, that's interesting because I can reinvest the dividends and compound them. Now, we know the new CEO is highly incentivized to get the share price between 55 and 75. The RSUs he has are because of the capital that he forfeited, leaving his previous investment gig, coming to Verizon. But PSUs, he gets nothing. It's the same thing as what Anthony Noto did. He gets nothing if he doesn't get the job done. And this guy has a timetable. His clock runs out end of 2027. For him to get anything, and I believe they work on a 90-day period, if I'm not mistaken, to have an average of 55 for over 90 days for that first tranche to be unlocked. Somebody can correct me if I'm wrong, but I'm pretty sure that's how it's structured. It's not a one day and run. So, I mean, think about that. 40 to 55, that's a spread of 15. I mean, that's roughly, what is that, like 37, 38% upside in 2 years on the lower end of the tranche. So you're basically saying, you know what? I can outperform the average of the market if that lower tranche gets hit and get paid 6.77% to sit here and wait for it to happen. At the very least, I'm going to collect the income. And it looks like we've already bottomed and we're hovering around a new resistance level. So Verizon's really interesting, especially from the aspect that you have close to $8 trillion sitting on the sidelines. What happens if the Fed starts cutting heavily over the next year? And what happens if the Fed effective rate gets under 3%? You have to think at some point that capital is coming back into the market and going to go into income producing assets, because I'll argue all day that that capital was never going into technology. That capital, if it was going to go in technology, it would have already been there. So we'll see. We'll see what happens. I mean, I think this is a really interesting setup because I think Verizon is a name people are going to trust for income. They're going to trust it for stability. And the reality is their debt isn't as scary as what people want to try and make it out to be. Yes, they have $127 billion in long-term debt. I get big number. It's a big number. But they are doing 50.2 billion in EBITDA. So they're running at pretty much a 2.2, 2.3 debt to EBITDA ratio. That's not scary at all. They have the firepower to service the debt, and you give them a 5-year period. If they don't go into buyback mode and they do things structurally, they should be able to wipe out 20 to 30 billion of that debt and get under 100 billion, which I believe would be a psychological advantage for people who read the balance sheet. So I think there's a lot to look forward to for Verizon if you are interested in income. If you're not interested in income and you're looking 5-10 years out, I'm not expecting it to beat the S&P. I'm just not. I think it would be foolish to say, you know what, it's got a good chance. I don't think it does. I don't think this is going to 100. I think that this can get somewhere within the band that they've set for Schulman's PSUs between 55 and 75 over the next 2 years. And if it gets to the higher end of the band, amazing. But that's also not why I'm in it. I'm in it for a steady dividend and the steady income because it complements my income producing portfolio and gives me access to a segment that's not going away. We're not getting rid of cell phones. And while competition is fierce between AT&T, T-Mobile, and Verizon, until something newer and better comes out, which who knows if the FTC will allow Starlink to compete with them or not, we're stuck with those three carriers. We've already seen consolidation. I don't think we see more consolidation. And to me, Verizon's the play from an income perspective. They do the most EBITDA. Their free cash flow is around $20 billion. They've reaffirmed guidance. They have a strong amount of retained free cash flow after the dividend payment. They're allocating roughly $11 billion a year to the dividend, so they have more than enough profitability to deal with the debt and to pay the dividend and figure out a plan to repay the debt. Now, here's the other thing. If Hassett gets put in the top spot, and if the Fed goes gangbusters and we get under 3% sometime next year, played out, what if Verizon issues a boatload of bonds at 4%, takes that capital and repays all the higher yielding debt that's 4.5% or higher? I don't remember what their debt stack looks like, but we can, let me go to their website because I believe they do have in the investor relations a sheet on their debt. So just give me one sec. Let's see if it's up. We have debt schedule of outstanding debt. Let's see if they updated it. So as of 9/30/2025, so that's interesting. We have the most recent one. So let's take a look at the schedule of debt. I'm already scared because it's so low on this, or so small on this. So hold on. All right, everybody can see it. All right, so maturity date, outstanding principal. Okay. I'm looking for big tranches over. So we got just over 4%, 2.8 billion. I wish this was in Excel that I could just filter it. You got 6.8, 105 million. Man, this would be so much easier if we could filter it. Some sevens, but it's 100 million. I mean, yeah, it would definitely help, but not a lot. 354 million at 6.4%. 457 million European, 4.75%. Oh, 2.25 billion over 5%, 5.85 over 278. Maybe I will. So I'm getting messages to look at the chat. VZ to 0. Why are you guys saying VZ to 0? Did Tevis and Roy put you up to this? Let's ask. Oh, is Roy here? Roy, do you want to come on for a little bit? I see you in the chat. You want a link? I'll send it to you. Give me a sec. I should probably stop sharing my screen so all this doesn't show. So I have no idea what's in the group chat with everybody. So we'll send Roy a link. All right, Roy, check your StreamYard. Or I'm sorry, check your StreamYard. Check your X account. So, yes. Oh, Tevis was in here too? You guys could have told me that. I'll send Tevis a link also. So, Tevis, if you're still here, I sent you a link also. So I'm going to go back to the schedule of debt real quick. I just want to finish going through it. Let's see. Oh, boy. We got somebody backstage. Give me 1 second, Mr. Backstager. Let's see. So we got 6.55%, 803 million, 910 million of 4/10, 2.36 billion at almost 5%. So you got a bunch of tranches that they could pay down, which would expand their margin a little bit because they'd be paying less on the interest to carry the debt. So that would be good. So, all right, let's bring him on. Mr. Roy, how are you?
Good. How are you, Steve?
Oh, hanging in there.
Good. Yeah. Tevis, we had a comment, on Verizon specifically. And, well, it's more that we saw that you were streaming. We're like, hey, maybe we'll send folks over. And you were talking about JEPI, which great. JEPI, awesome. and Verizon, which I don't understand why you're interested in Verizon, bro. I know you like dividends and everything, but there's some risk there. I think Schulman does a good job of pumping the stock initially, but he's a terrible, terrible person to be at the helm. I think he has no idea what he's doing. I found out a little bit more about like what went wrong in his last few years at PayPal, which I don't know if I'm at liberty to disclose. It's not insider information necessarily. It's just somebody that knew somebody that knew somebody shared with me. So I don't know how credible it is, but it seems like it lines up with exactly what happened. And I think the dude is lost, and he's good at promoting headlines, which over the short term can be a good thing. But you're looking at this long term. Are you mostly looking at this because of the it looks like a 6.8% dividend yield?
Yeah, I mean, look, this is not something that I'm putting capital in that I want to grow per se. So I'm not. This is not a replacement for. And you know how I look at things. Can it beat the S&P or not? This is not beating the S&P in my opinion.
No.
Okay. Like, and I was very clear at the beginning of the Verizon segment that the chances of Verizon outpacing the S&P are so slim that I could probably bet my pinky on it and feel confident, because it's just, what the hell are the chances? It's down 10% in the past decade. It's probably not beating the S&P, but I don't think it goes lower than it does here. It looks like it's bottomed out, and the dividend is lucrative enough where buying the yield on cost here as part of an income producing portfolio to me makes sense. And if this thing does run to 55 or 60, it gives you a good exit point where you also collected a dividend along the way.
Yeah, that doesn't sound too exciting to me. And I don't know, like I kind of agree with part of it though. Like looking at it where it's at, like this is not a stock that's going to like crash to like $20 a share in like 2 years or something like that, barring everything going wrong in the world all at once. But it might actually do decently well, like over the next year, since it does have a dividend yield. As rates fall, people are looking for that safe premium. Verizon might benefit from that. I thought that might be this year, but like rate cuts were delayed for a long time as well, and had ramifications on the market. And then Schulman again does a good job of like getting the market to be interested in some of the headlines, even if there's absolutely no substance. And that can work long enough that, you know, the stock does okay for the next year or two. But man, does the debt concern you at all, or the lack of revenue growth, or is it just like the dividend is sustainable enough?
The debt would concern me at 120 something billion if they weren't doing 50 billion in EBITDA. They have a debt to EBITDA ratio about 2.2x, which is very low for companies that are capital intensive, and their profitability is more than enough to sustain the debt, continue increasing the dividend, and start to pay down the debt. So I'm not worried about it. But since you're on, I think we should transition to something else. I think we should get your opinion. Are we getting into the S&P 500 on Friday or not? SoFi,
no, 11% chance that we do. So there's a chance over the next year. So from now till the end of next year, I think it's extremely likely, like maybe 95% chance. There's enough names, and I need to do a little bit more research on this. Tevis and I went over some of the names as well that are out there, but we never know how many slots that there are. It might be one of those cases, we've seen it once earlier this year, where they said, okay, we're good. We're not adding or removing anybody. There might be one or two. So if that's the case, like if it's 3 or less, I think it's unlikely here. But in the next like year, I think certainly. So what do you think? Is it how likely, how unlikely?
I haven't even seen which other companies are up for it. So if you could let me know, that'd be great.
Yeah. So one that I think is not going to get in, but it gets a lot of talk every time, is MicroStrategy or Strategy, MSTR, simply because they can claim to be EPS profitable just based on the I can't remember the accounting rule that changed that allowed them to do that related to EPS for digital asset treasuries. It's like over a year ago. Regardless, they can technically meet the requirements, but they can't sustainably put up profitable EPS. It depends on the price movement of Bitcoin. That's it. And they've added, Yeah, they've added Coinbase, they've added Robinhood, they've added Block, but I just don't see that name being added. I think that maybe ever, or at least certainly not here. And the debt level is pretty concerning too. So Ferguson is one that's been talked about a while.
Oh, really?
It's an industrial. It's not in. It's one that a lot of people are like, oh, aren't they in already? They probably should have been, but it's been talked about since like 2022, maybe 2023 early. I know for sure. I keep thinking they're going to get in, and they will at some point. This may be the day. We have I always get them mixed up. Vertiv or Vive. Vive, I believe, got in 2 quarters ago. Vertiv is one that hasn't yet. They benefit from the AI space. They check all the right boxes. The growth is there. The industry is there. They're in a little bit differentiated sector, which I think they like. It's a tech stock, but I think that one's very, very likely to go in. SoFi was one of those. Let me pull up. I had a chart here. There was one pharmaceutical company that Barron's made a good case for that I had never heard of before. But there's usually like when the S&P 500 announces the inductees, there's usually one that I haven't thought of in years and kind of forgot about, or a company that I never have heard of before, or at least I didn't know that they're publicly traded. So that might be the one. It might be some others as well. Let me pull up and see if I can get. Yeah, so
I wouldn't be surprised if Vertiv gets in. Vertiv, with all the AI build out, I would not be surprised.
ALNY is the pharmaceutical that Barron's put out there. I'd never heard of them before. I don't know what they do, but and then you have Ares Management, which I think if I was going to pick 2, it's Ares and Vertiv.
I love Ares Management.
Yeah, it's a little bit surprising that it's not already in, but yeah, they all hit market cap, they all hit EPS. So this is.
Wait, hold on. Are you using Fiscal AI also?
Of course.
Well, all you guys using Fiscal AI these days?
Yes.
I feel like everybody that I hang out with uses Fiscal AI. It's crazy.
It is, yeah. It's one of those. So I'm a spendthrift. You can call me a cheapskate, I guess, if you want. But I rarely pay for products, even if I enjoy them. I don't for subscriptions. To the point where I don't even pay for YouTube Premium. It's not because of the price point, believe me. And I probably should, but that's just the way I operate. Fiscal AI was actually good enough as a product that I was like, this is an exception where I think that I might go ahead and buy the Pro version. And so I was kind of thinking about it. It's like, maybe I'll wait and see what they do for Black Friday. Instead, they actually they're a sponsor. They're my first and only sponsor.
Whoa.
Yeah, it's been like half a month, but I've been, so I'm sure, Steve, like, especially the way you're blowing up on YouTube and, your presence on Seeking Alpha and on X, you get a billion offers. And as small as I am, I get a lot of them too. Some from very credible, nice companies where I'm like, but, this is not really a product that I'd use or love. Maybe my audience would. And so even there, I'm like hesitant. And then there's a whole bunch of like sketchy, like, let us know your price point. Contact us on Telegram, and we'll send money to you on Cash App or whatever it is. It's like so. This is one of like 3 companies that I've actually like actively considered and thought about and been pretty comfortable with. One, they don't do sponsorships. The other, it just wasn't the right timing. And I looked and I was like, I wasn't ready to commit. And then with Fiscal, I'm like, man, I already like the product, so why not? So if I can mention, if you guys go to my YouTube station, you can just search for Crossroads.
Throw the link here.
Yeah, let me do that actually. Thank you. There's I'm not sure if it's still running, but the link will save you a little bit of money. There is a 2-week free trial. There it is. Oh, it's not. Let me put it in the private chat.
Go to the private chat. I probably didn't set the stream up as sharing because I was just doing it myself. So here we go.
Yeah.
All right, everyone. So if you're interested, this is Roy's link for Fiscal AI. And the fact that now him, Chris Patel, and Tanner, and is Tevis using it also?
I don't know that Tevis is.
Amit uses it sometimes.
Yeah,
so at least 4 of them use it, so it's got to be good.
And I believe Matt Money is, he's looked at it because of Chris Patel. He actually ended up using my link because we had lunch, and I was talking to him about the recent sponsorship, and he's
Well,
like,
you guys live near each other. You
"It's
freaking
awesome."
Matt,
Yeah.
TJ, freaking um who else lives down there? It's two other people.
TJ is not in Houston, but he's in Texas, and I get to see him occasionally. So,
Dougie lives down there.
yeah, Doug,
You
yep,
guys all
Michelle.
live down there.
I'm not hooked up with them yet. There's a few others too that you may not know as much. Yeah, Houston's a big city, so I mean New York is
Enjoying
too,
that
but
no income tax.
high property tax. So, but yeah, a lot of good things in Texas. Traffic and property tax are the two that are not.
Really nice. So,
Yeah.
what are you buying right now, Roy?
I've been buying some VG, doing my normal DCA into Bitcoin. I bought some BMNR and Ethereum last week, but largely not, just kind of stocking up on some cash and just trying to make sure that my cash levels increase between now and the end of the year, and it's ready to go for January. I think we might have a little bit of a pullback in January, just on some of those names that have run really hard, that people are waiting just for tax beneficial reasons. So what about you?
I bought more BMNR today. I bought more QXO today. And I bought some Verizon today. I am cautiously optimistic about the Fed. I think they're backed into a corner. We'll see what happens next week. If they do not cut, I'm worried we're going to 62.50 by the end of the year for very specific reasons around unemployment. But I am feeling good about the market overall, and I'm getting really optimistic about QXO, and that's flying under the radar. And it's something that I think is going to do really well over the next 2 years.
Yeah, makes sense. So are you in Verizon already, or are you looking at it?
No, I'm in it. I'm just adding to it. It's part of an income producing portfolio with a lot of other positions. And I got that. I got Enbridge, Altria, Realty Income, stuff none of you guys would be interested in. But,
Very nice.
reoccurring income.
Yeah. Do you think we get a Santa rally this year?
If the Fed cuts on the 10th, I am upping my target to 72.20 or something like that.
That's a huge swing there.
And I have been at 7,000 the entire year.
Yeah.
I haven't moved. If the Fed cuts, I think we blow past 7,000 by the end of the year, because there's not a lot of things the tax loss harvest on. Like, this is not a setup where I think you're going to see people selling Microsoft or Meta, or, I mean, I know you'd sell Meta because you don't want to buy Meta, but,
Yeah.
in all seriousness, like, I don't think people are going to be selling Palantir or SoFi or Hood, because there's really nothing that the people that are investing in those things are in have losses on.
Yeah.
So I don't know that you see the tax loss harvesting season that you normally say.
Yeah, I think we've been feeling it in some of the names that you and I have in common. One thanks to you is Block. They had a fireside chat that I guess didn't go very well today. We're down like 5 or 6% at some point.
I've been out of Block for a long time.
But yeah, okay, no, that's good. I still have my now $60 worth of Block instead of 100.
Yeah,
but
I've been out of Block for a long time. I think I sold it close to even. I mean, I'm just then PayPal. PayPal's annoying me. I'm not in it anymore.
Really?
I got out around 71 or 72, that area, maybe 68, somewhere in that band.
Yeah.
But I just got annoyed with it, and I think it's going to be very hard for PayPal, as good as the numbers are, for the market to get excited about it. And I just think, you know what, these days it's either the S&P or big tech, because why take a chance? Unless there's a story that is just so obvious that the market is overlooking. But this isn't 2022. This isn't Hood, SoFi, Palantir, all these names that are obvious plays that you can wait out in. I'm not seeing that. Now, you can make that argument with NeoClouds, and I am getting more interested in CoreWeave and Nebius
Yeah.
because after the big drawdown, they actually look attractive based on the forward numbers, and that's stuff that I wouldn't mind starting a position and building it and waiting it out for 3 to 5 years because I do think they could be much bigger in 3 or 5 years.
Yeah. Yeah. I did an invest and investigate thing on Nebius starting at around like $25. And I sold and just decided like, I think it's a solid, good company, but I'm like, I have too much beta in my portfolio. So I'll just put it in NVIDIA, and NVIDIA has done well. But Nebius has done incredibly well. So, you know, short term it was a mistake. Long term, probably Nebius will outperform too there. But yeah, it's one that for me got back on the radar maybe 2 weeks ago just because of that drawdown. And I'm not afraid to buy it at a higher price than I sold it. It's a good company, and there's a price above the price that I sold it at that I'd be happy to own it again. So,
so I think the question for you is, are you worried about Google's TPUs with NVIDIA?
not really. I mean, it's not like ideally NVIDIA is the only one that has and designs chips, have data centers, everything that it flow through NVIDIA. I don't see anything from Google, and then also Amazon. There's a related piece that came out with their Tensor chipsets. Trainium, that's what it was for Amazon. Amazon claims that it's more efficient. Google has certain claims about the TPUs. We know, and there's been studies that were done. I actually posted about one last week, and I talked about this too with Tevis here. It's funny how similar the chats are. Let me see if I can pull it up. But actually, I won't even bother there. But in essence, like NVIDIA, even with their older chips, there's a lot more throughput. Usually, there's a lot more efficiency as well. And even if Amazon's chipsets in Ironwood, their 7th generation TPUs for Google are more efficient, efficiency isn't the only thing and the only thing that people go for as far as chipsets, whether it's GPUs, CPUs, TPUs in this case. So if NVIDIA was priced at like 100 times price earnings, yeah, I'd be pretty concerned. Last week, there was a point, Steve, where the forward price earnings for 2026 for not only for NVIDIA was it lower than Google, it was lower than Apple, and Apple doesn't grow. So no, I'm not concerned about NVIDIA here.
Have you seen my price chart for them recently?
No.
With the forward valuation stacked up against everybody?
No.
Oh, it will make your freaking head spin. Jesus, hold on. I was actually thinking about buying more NVIDIA, and I don't need any more NVIDIA. Like I'm thinking about now considering that not a full position because the market has discounted so much, it's getting crazy.
Yeah, I have one portfolio where I have like an uneven amount of shares in NVIDIA, and I might just buy between now and the end of the year just to round that.
Yeah, but you do that on purpose because that makes you buy an even amount to write another call. I know your game.
But I mean, like, it's hard to look at NVIDIA and seriously, it's going to be volatile. But
in the next 5 years, to look at NVIDIA and take this seriously, that's trading at 19 times forward earnings.
I mean, that's crazy. Like Meta's very attractive, obviously, too, and you're buying it. But
in all seriousness, with 103% expected forward growth over 2 years.
Oh, wow. When did you do this chart? It was last week, I'm assuming?
I updated it probably Thursday night. So the numbers from the analysts have not really changed much, probably. And I added some other companies in there. Like the fact that both Meta and NVIDIA are trading at a lower forward multiple than Coca-Cola is disgusting. The fact that they're trading at a lower forward multiple than Starbucks is disgusting.
Yeah, I mean, like, and just for the Mag 7, a lower multiple than Apple.
Right. Well, they all have lower multiple than Apple than Tesla, except for Tesla.
Yeah, Apple's been on quite a run, so I don't do that, but I know flight to safety and all that. There's some, and they're doing a few things right.
And
like
look, I'll never get mad at Apple at 30 times earnings because you have a lot of other companies that trade at 30 times earnings that probably shouldn't, and if they are, I'd rather be buying Apple with $100 billion of profitability every year But that being said, NVIDIA is on track to become the most profitable company in the world, and people are treating this like a tobacco company.
Yeah, and the earnings growth there, the revenue. I mean, no matter how you look at it, the Rule of 40, it's all just absolutely ridiculous. Margins, yeah, it's and that's a tough thing too. Of like, people often ask like, why aren't you in Google, Amazon? Not so much Apple, but Microsoft. We were asked about that too. Is like good companies, they'll be around a long time. But Nvidia is sitting right there at 24 times.
You ready for
According
me to blow your mind? You
What's
ready?
that?
You
Yeah.
ready to get your mind blown?
I'm nervous.
NVIDIA versus Broadcom and AMD on profitability metrics.
Oh,
Look
man.
at their freaking margins.
Yeah.
Net income margin against Broadcom is an extra 22%. I mean, you're paying 39 times EBITDA for freaking NVIDIA, but 55 times for Broadcom. Like, what are we doing here?
Yeah. And like the bear argument is more competition, and you're seeing that, from Google and Amazon. Even if it's not a 1-for-1, it'll impact prices, and it'll impact margin as a result. But it's still, I don't know that many people dispute this. NVIDIA is best in class across the board, and it's going to trade at a premium, or it should trade at a premium relative to that, because you can see it in the margins, you can see it in the revenue growth, you can see it in the earnings growth, you can see it, across the board of what they're doing. So I have no problem, like you, with Apple trading at 30 times because it's Apple. I wouldn't invest in it there, but it's just like, why is NVIDIA trading under that? Why is Microsoft trading under that? I'm not even that bullish on Microsoft. Why is Meta? Like, I don't know.
I just became a Microsoft shareholder, and I think it's a very complete company. At the same time, I'm having a very hard time with NVIDIA at these numbers, because when Jensen comes out with Rubin next year, he's going to be like, cool, check this out. And everybody's going to buy it. What are we saying? That people aren't going to buy the Rubin chips? I mean, come on.
Yeah. There was a fireside chat that NVIDIA was a part of too, where they had said that $500 billion that they figure that they put out over multiple quarters. There's over a couple of years. Let me make sure I'm accurate here. That didn't include OpenAI revenue, and of course, it doesn't include China revenue too. That could also be like we're seeing tariff deals and things worked out. That could be part of tariff concessions as it relates. I don't think NVIDIA is counting on that or needs that. Let's see, $500 billion worth of Blackwell and Vera Rubin. It's not based on any OpenAI amount at all. So they're being very conservative there with any forward-looking projection numbers. And still, it seems like the market doesn't believe them, despite the fact they've been putting up these numbers for years.
Yeah, I think
5 quarters. 500 billion in 5 quarters. Sorry.
Very difficult not to take NVIDIA seriously here. I mean, does it deserve to be down after the best earnings report I've ever seen? I don't think so, but companies that are $4 trillion are not supposed to grow their revenue year over year by 63%. It is not. I mean, this is not normal. And the growth rates next year are not normal. And it's just quite arguably the best company there is right now.
I'm not going to argue against that.
It just doesn't make sense.
Yeah, I mean, like, you can look really far out. In like 10 years, there's a lot of things that are unknown. But like, that's when, honestly, like a big part of my investment style and thesis is leadership, because you may not know what the world looks like 10 years out and what the business looks like, what everything looks like. But if the business is in the hands of somebody that has incredible skill, and I think Jensen might be, if he's not the best CEO on the planet, he's like top 5 easy.
Easy top 5.
So like, in the hands of that, like, look at all the different pivots that NVIDIA made. Initially, it was just a computer parts business, largely revolving around video games, and then Bitcoin mining. And then, like, look at NVIDIA now. People try to compare NVIDIA to where they were like 5 years ago, I was like, this is a very different company. And they will continue to innovate and iterate and be a leader for a long, long time. I think as long as Jensen's there, he's not showing any signs of slowing down. So I think that, if we're looking at a decade out, one thing that we can not guarantee, but high degree likelihood is Jensen's still going to be there. In which case, I have no problem just saying, okay, great, here's my money. Make it work.
Yeah, I'm on the same page. I mean, I'm not seeing any indication that the CapEx spend is going to slow over the next couple of years. I'm also not seeing any indication that TPUs are going to displace GPUs. And I think that we are at least 3 or 4 years from maintenance mode. And every generation of new chip, depending on how good they are, could expand that. So I think NVIDIA's got a lot of room to run.
Yeah. And then people are concerned because the stock is up, a decent amount this year, especially if you look at tariff lows. But the reality is revenue will eventually slow down. People are not going to be spending like this for 10 years in a row. And you get to the law of large numbers, which frankly we're already there at NVIDIA just because they have harder and harder comps. But Apple is growing barely any revenue and they're priced at 30 times earnings. NVIDIA is under that. This is not scary where NVIDIA is at. Revenue is not going to go backwards. The amount of increase will slow down, but yeah.
I mean, look, great company. I don't know that any other company is going to catch them. And not a lot of people talk about the amount of capital Jensen's going to plow back into buybacks also. And NVIDIA may become the Berkshire Hathaway of tech in the next 5 years at this rate.
That's been kind of fun just to see. Other companies will do this too, through ventures funds usually, but sometimes direct ownership and a stake in a company. And that is probably one of the biggest problems of NVIDIA is they have too much cash. So that's a really nice problem to have.
So a really nice problem to have.
Sign me up for that,
I mean, last time I checked, it's not a bad thing to buy equity in OpenAI and all these other companies. And over the next 5 years, they could become the Berkshire Hathaway of tech and have a portfolio of assets that is worth more than market caps of companies.
Oh, yeah.
I think we're convincing me to buy more NVIDIA at this point.
I think we're convincing each other to buy more NVIDIA. So,
look, if NVIDIA was at 220, 225, I would say, you know what? I'm just holding it. But at these levels, it's being disrespected, and there's no reason it can't go back to 215.
For sure. Once the market, it's been a little bit on risk off mode. It changes every day, it seems like. But it might be an overhang for a little bit. But man, I would actually love if NVIDIA just keeps dropping even more, because I have no fear in buying more of that company. And the cheaper it gets, as long if there's a reason for it, Taiwan's invaded, I'll be like, well,
different story.
Let me let the dust settle there. But just like Amazon, the Trainium chips, the Tensor chips with Google, it's going to happen.
Look, if Taiwan gets invaded, we have way bigger problems than investing in NVIDIA.
Yeah, and it'll still probably do quite well as a company, but it'll take some time. It's going to not be fun holding that stock if that happens for years, but over 10 years, yeah.
So I think the real question is, what are we looking at for the end of the year? Are we looking at starting new positions, or is it just converging on what we think is just going to work?
I mean, a lot depends on what happens between now and the end of the year, but probably mostly just going to be focusing on adding to positions in my portfolio. VG is the one that I'm currently in invest and investigate. So I doubled my very small position. It's 200 shares. Wow, big deal. But I may be doing that probably not this week, but maybe next week I'll double it again, depending on price action and, of course, my investigation. I haven't had time, don't really have time until maybe the end of this week. I like it as an opportunity that's kind of longer term. Beyond that, like there's some positions out there that I'd like to buy if it drops, if it comes to me, but nothing new, at least right now at this point. What about for you?
Nothing new. Just the newest thing is QXO. So it's not really new anymore. It's about a month now. But my thesis is the same that it's been. The big are just going to get bigger. I think it's very hard to compete with these companies. And there's nothing that's getting me excited the way SoFi was, the way Palantir was, the way other companies were. I think Meta and Nvidia and Amazon right now are, you can't even say sleepers, but I think they're going to generate the most ROI over the next year from the Mag 7. And I wouldn't be opposed. I mean, look, Nvidia and Meta I have full positions on. I'm still building out the Amazon position, and I still believe there's a very good narrative shaping up that they could get to $1 trillion in revenue in 2029. They're an 11.2% margin on operating. And if they can get that margin up to 18 to 20%, you're talking about 180 to 200 billion of operating income. That's a number no company is putting up now. And if they do that, you got to think, if companies hit 5 trillion without doing that, Amazon could potentially get to 6 or 7 trillion, which is 1.5 to 2 times where they're trading.
Mm-hmm.
So I like Amazon very long term right now.
Yeah, it's Amazon's one I'll probably never invest in, even though I always think it's solid and or even good, actually, just better opportunities. So there's 5, and I wanted to pull up them just to see how they did. Didn't follow these today. Nebius and Rocket Lab are 2 that I've done the due diligence, and if they fall to a certain price, I'll be happy to own both. They've been falling, and so there's a target where, yeah, I'll start buying those. Coinbase is one I'll probably wait for crypto winter, and I might go into that because I think, just like this last time, that there's a really good opportunity there. Cloudflare, it'll probably never fall where I want it to. Yeah, those are the big ones that I'm targeting. So
Cloudflare was one of my best trades, and I normally don't do this. One of my buddies said to me, listen, buy Cloudflare. They're protecting the internet. This is back in 2021 or maybe end of 2020.
Oh,
so
man.
I bought some. I think my average price was like 34.
Yeah.
I did not buy nearly enough. I bought 100 shares. Like, all right, whatever. I'll throw a couple grand into it. I ended up selling it at 170. And then it crashed.
Yeah.
But, I mean, I did pretty damn well on it.
Yeah, I love that company. Matthew Prince is just a premium CEO. It trades at a premium, though. And it's been on the radar for a while now. And it's like, man, I don't think like 140 is where I'd like to have it. It's trading above 200 right now. It's like, well, probably won't happen. But if it does, it's one of those dream opportunities. And like Figure is the other one. That's the run by the former CEO from SoFi. So recently IPO'd. They had their first earnings since they were a public company. And frankly, they knocked it out of the park. But that's one where I still need to do a little bit more DD. I've done quite a bit. And then like, there's a thought in the back of my mind that's it's a little bit dangerous thought. So Figure is very much associated with crypto, but its value, its revenue, everything about its business, the move of Bitcoin, Ethereum, everything like that, it doesn't matter one bit for Figure. But the market, it does not treat the stock that way. It lumps it in the basket with every other crypto name. So I kind of have a thought in the back of my mind that when we get crypto winter, that Figure will be sold off like everything else initially. And then the market will be like, wait, why are we selling this way down here when it's EPS profitable? They're a unicorn with a number of things that they've done with crypto. They're growing very rapidly, actually. But I might start a small position and then just, look for an opportunity to expand it just so it continues to be. But it's very high on the radar too. So
I'll take a look at it.
Yeah, I think you'll really like it, especially like they're very clear on the basis points that they're able to save just because of what they do with crypto. Also, the time frame too. It's a platform rather than just an individual lending company, which I really like. And they have a lot of, I mean, it's you can just look at it. Like, despite the macro that we're in, the level of growth that they've actually been able to put out is impressive. And they're not optimized for EPS at all. They're focused on growth. They're accidentally EPS profitable. The other thing, too, that I like about it, Steve, is most of it runs on their own blockchain. It's Providence blockchain. And so you can see, just because it's tokenized, it's right there on chain, exactly where they're at with a whole lot of their measures. There's not a lot of guesswork when it comes to looking at like what their earnings is going to look like for the next year. Not the next year, the oncoming quarter. So yeah, it's worth a look.
Interesting. Yeah, I'll take a look at it.
And before I go right quick, I wanted to say that you've accidentally inspired me to become a dividend investor, and I now have 4
Stop
dividends.
it! Don't even do that.
I have 10 total positions. Well, now 11 because VG. It's maybe a full position or not. 4 of them are dividend stocks.
Okay, hold on. Everybody stop it. He's gonna say NVIDIA is a dividend stock, so he's a dividend investor. He's going to say that PayPal is a dividend stock, so he's a dividend investor.
1% yield.
What else is he going to say? Oh my God! So NVIDIA, PayPal. What else in your portfolio is paying a stupid?
You own this one as well, BM&R.
BM&R is paying a dividend.
Which
I'm not going to get the last one.
It's BG.
Oh no, BG. VG pays a dividend.
What did you think about BM&R's dividend, by the way?
So I think it doesn't matter that it's 1 penny. It's more the fact that they did it allows them the ability to disperse when they start staking if they want to. So I think it's more symbolic of what could or could not happen. But I do not want them to freaking pay a dividend.
Yeah, no, later, once they've actually hit their 5%, if they want to pay a small dividend, fine, that's okay. But
buy back shares or buy more Ethereum, one of the two.
I think so. Or moonshots at that point would be fine.
Right?
But yeah, Bitcoin, they already have some 192. So yeah, I was curious because I know you love your dividends. So
I do love my dividends.
It's 30-something% of my portfolio are dividend stocks now. So I guess that's one thing too. Like, if you hold your stock long enough, you too will become a dividend investor for most positions. Nature of the beast. SoFi will pay it one day. Yeah. All right. Well, thank you for having me on.
Well, thank you for coming on. We need to figure something out to do something together on both channels. So we need to figure that out.
Yeah, that'd be fun.
Sounds good. Well, I'm going to get going. Roy, thank you for coming. Before you leave, can you send me the link to your YouTube channel so I can put it up for everybody?
Yeah, let me do that right quick. The good handles were gone, so it always looks like I'm a bot or something like that. But here,
I've never asked you, where the hell did you come up with the name Crossroads?
Yeah, that was a relic from a long time ago, but it was one where I kind of had it anyway already. And I was like, we're oftentimes at the crossroads of many decisions in life, whether it relates to the stock market or not. So I'll run with it. So I like it.
All right. So hold on. Let me go into the private. So this is Roy's YouTube channel. Please go subscribe. He puts out great content. Hopefully you'll see Roy and myself do more stuff together. And then his X handle, Ray was nice enough to put it on. So please go follow Roy on X and YouTube. And then I am going to go finish my article right now. And Amit and I will be live at 9:45. So go get your milk and cookies. It has a very funny name in the title. All right, Roy. See you later.
See ya. Thanks for having me on.
Thanks, everyone. See you at 9:45 with Amit.